Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got green on the screen with stocks rising overnight on hopes that U.S.-China trade tensions could soon ease. And we have President Donald Trump signaling he does not plan to remove Federal Reserve Chair Jerome Powell from his post as central bank leader. So that returns some risk appetite back to the markets with some stability, some sense of it at least. And that's helping the Dow Jones Industrial Average up 1.1%. 420 points higher to 39,607. The S&P 500 climbed 1.7% to 5,376. And we have the Nasdaq Composite outperforming with a rally of 2.5%. So all three indexes posting back-to-back gains. And helping us out this morning, we've got Jason Britton. He is the founder and CIO at Reflection Asset Management. Jason, thanks for joining us on the show today. How are you doing?
I'm great, Ryan. Good morning. How are you?
Great to have you on, Jason. And it looks like markets are doing great as well. And this is where I'm going to get your help to figure out where we are right now, because it's been back and forth. And then you've got the sentiment from investors being quite sluggish in the past few weeks. And now you've got a bit of a reprieve of sorts. Is this the time to get excited about getting back into the markets now?
So, Ryan, I think there are pockets of opportunity in the market right now. I mean, you described it with your opening comments. There are two things at play here. There's the near-term volatility of the markets reacting and overreacting to President Trump and the tariffs and the potential trade war. There's the underlying earnings and what I will call corporate performance and fundamentals. And then you have that third, which is the wild card, the consumer, especially the American consumer. And you're right, the sluggishness of that has required a lot of firms to bring in their forecasts for growth, with several prognosticating recession in the near term.
Yep, that's right. I've been hearing from a couple of them, including Walmart, many retailers just cutting back on where things are going because it's so tough to forecast the spending, their customer spending as well. Are you seeing any sign of that increasing? Is that going to be the case for this earnings season and more to come?
I think it will be. For this earnings season going forward, I think we're going to see corporate executives very reticent to make strong commitments one way or the other. It's incredibly difficult for, as you mentioned, a company like Walmart or NVIDIA or someone to significantly shift their supply chains in the near term. So they're literally on a rocking rowboat trying to balance a house of cards. It's quite the visual image.
Yeah, house of cards indeed. So let's talk about what the global growth outlook is right now. We had the IMF coming out yesterday with their report of the outlook of the global economy. And one of the highlights was how they have downgraded their forecast for China. They're looking a bit more pessimistic about where things are going. Where are you right now when you look at where things are going? There's a lot of talk about a recession early on. So are we now, with the latest dialing back from Donald Trump, maybe seeing a reduced odds of that happening?
So I think if Secretary Beth and on the Treasury side can have his way, they'll keep the 10-year under 4.5%, and they'll get a deal as quickly as possible with the Chinese government. It won't be at 145%, but it likely won't be at 5% either. As long as the market settles in on a number, I think you'll see a collective sigh of relief. I think you'll see certain sectors like financials and discretionary who've done well when the market news has been good and have done poorly when things have swung the other way be the drivers. Really interesting thing, though, is going to be how quickly can they get it done, because if they continue to erode U.S. consumer confidence, that's going to take a while to bounce back. That really is the wild card here.
All right, let's talk about defense. This is where you've got so much uncertainty in the backdrop of where things are right now. So where would people be able to find perhaps some of the more defensive names or the better places to protect their capital?
So looking at specifically just the U.S. market, you have obviously utilities and energy have historically been safe havens in the U.S. market, dividend payers with not a lot of volatility. You typically, in a trade war, will see healthcare do well because it's outside of pharmaceuticals, healthcare delivery and managed care is usually done domestically. So that sector would normally do well, but simultaneously Trump has decided to attack Medicare and Medicaid reimbursements, which has made things really challenging for those folks too. So there really isn't, other than traditionally gold, Swiss franc, and then utilities and energy, too many places to hide in a market this tumultuous.
Yeah, would you be going to gold per se or into gold miners?
So I happen to like gold itself, the physical commodity expressed through an ETF, rather than the gold miners, because once you start talking about the gold miners, it's not just the physical metal, but it's also transportation, logistics, etc. So it opens itself up to be a slightly less than pure play.
All right, so we've got a couple of things you can look at. Gold will be one of them. Of course, they've been doing pretty well, up more than, I believe, 30 or 40% so far in the past year. So a lot of capital flow into those places. And talk about where things are flowing. We've been seeing the US dollar hitting 3-year lows recently. How much of a concern is that for US companies when you look at the earnings and the potential way it could play out for how folks are viewing the US economy?
Well, so most of the U.S. mega-cap companies source a great deal of their earnings from overseas. So it's not a huge concern on the weakening dollar. And in fact, that's the one bright spot for U.S. importers, is that the weakening dollar has made it so that the tariffs have stung a little bit less. So the reality is that most of us are trying very hard to understand how quickly is this going to come to resolution. It is a self-inflicted economic wound that was completely unnecessary. Balance of payments and trades and deficits are not by definition bad. They tend to be favoring those economies that are extremely strong and service and technology oriented. That was the United States. It's a misapplication, in my opinion, of bad economic theory and bad public policy.
All right, let's talk about Jerome Powell right now. So we've got a bit of a back and forth going on here with Donald Trump at first, signaling he might want to get him out of the position. Now he's saying no, he's not going to do that. But of course, in the process is what the Fed's going to be doing, and that's where they've got a bit of a balancing act. So we've been talking about how the US is going through a bit of a slump. At the same time, there are still potential inflationary pressures to deal with. So where do you see the Fed leading towards in terms of rate cuts?
So I think the Fed has said outright that they are in a wait-and-see position. You've got the economic data in terms of job creation. Remember, our Federal Reserve has a dual mandate, right? Full employment and low inflation. And the last two inflation prints have been higher than their target stated 2%. So there's still upward pressure on that. What they're really concerned about is stagflation and finding ways where prices are rising but the economy is weakening. And you add to that the idea that, historically speaking, and again, we're in a period of shifting norms in the United States, the White House and the executive branch did not interfere with traditional agencies like the Federal Reserve. So his willingness to upend political norms made the market very nervous. If you have a political Fed, you can sort of take some of the certainty out of the game, which is why I think he was out quickly today as the Secretary of Treasury's urging to calm the markets and say, no, Jerome's got 1 year left. Let's let Chairman Powell finish his term.
All right, a good wrap-up of where things are right now and how to position yourself in the markets. We've been in conversation with Jason Britton. He is the founder and CIO at Reflection Asset Management. Jason, great chatting with you. Thanks for your time.
Appreciate it, Ryan. Have a good day.
You too. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.